Hey Bowtie Nation, Joseph Hogue here with your weekly stock market update, 9 a.m. Eastern every Monday morning with the stocks to watch and the stock market news you need to see. And Nation, this week I'm breaking out my toolbox to show you a cheat code to finding the best stocks. Instead of spending hours researching, I'm going to show you the quick numbers to look for and the process that just uncovered a must buy stock in one of the hottest industries in the market. Stick around for important updates to shares of Netflix, Super Microcomputer, ticker SMCI, and an updated market outlook. Back to that one must buy stock though, and Nation, investors ask me all the time how to pick stocks without making it a full time job, without spending the 60 hours a week I put in over a decade as a professional analyst. Now, spending that time putting in the work to analyze the financial statements and understand a company's business model, that is always going to be the most certain way of finding those stocks. But there's also another way, a cheat code to finding the companies with a competitive advantage that is going to translate into those higher returns. I'll count down to the top 3 stocks to watch in the software industry, show you how to use this cheat code on any stock you want, and then highlight one stock that is flashing must buy right now. I'll show you how to find all this next, but let's get started with PTC Inc., ticker PTC, a provider of industrial software workflows. The core revenue engine here is its subscription software plus maintenance, which sets the company up to generate that progressively higher cash flow every single year. Revenue growth is only in the single digits here, but the company produces some of the highest profitability margins in its industry, a gross margin of 83% and almost 36% operating margin. Even better though, it's been able to drive improvement in both those measures over the past 5 years, so it's converting revenue into even more profits over time. You probably picked up on much of that stock picking cheat code in that analysis, but I want to talk you through this because just 5 minutes of analysis is all you need to make sure you're buying the best stocks. And we're going to do that by letting the numbers tell us a story. Nation, the most important part of an analyst's job is finding which companies have a competitive advantage, something in its management or the product that allows it to take market share and produce those higher profits versus competitors. It could be a technological advantage, a pricing power over buyers or suppliers, or any number of things, but this is the key that translates into years of returns. For a professional analyst with 60 plus hours a week to spend, that means becoming an expert in your assigned stocks and learning everything you can about them. But then most of us don't have that kind of time, so I'm going to show you how to find the numbers that are your best clue into which stocks have those competitive advantages. First, understand that you have to do this on an industry basis. We're going to be comparing measures like profitability and revenue growth that just won't be comparable across industries, much less sectors. Remember, a sector like consumer staples, energy, financials, or materials, that is a broad group of companies that all fit together in a one piece of the economy. Think of sectors like all the products in an entire aisle at the grocery store. Industries, then, are smaller groupings within each sector, the companies that sell a similar product or satisfy a similar need. Within the technology sector, we find industries like IT services, semiconductors, software, and hardware. So if a sector is like the breakfast food aisle at the store, industries would be parts of that aisle, like hot breakfast, cereals, granola bars, or pancakes. So then the reason that you have to do this analysis at that industry level, comparing only the stocks within a single industry at a time, is because across industries, the numbers just aren't comparable. In this video, looking at the software stocks within the tech sector, we see margins or profitability of 70 and 80% of sales and revenue growth as high as 53%. Now comparing that with an industry like consumer staples retailers, and you see there is just no comparison. Here in a much more mature industry, the best you're going to find is profitability of 30% and revenue growth in the low double digits. But that doesn't mean that returns on some of these consumer retailers are going to be lower. Shares of Walmart, ticker WMT, are up almost 30% in the last year with its paltry 4% operating margin, versus Intuit with its 26% operating profitability, more than 6 times better, but with its shares down 12% in the last year. Walmart has the competitive advantage in its industry and is able to use that, even those lower margins and the growth, to produce higher returns, whereas Intuit is just kind of an also ran in its industry and is falling behind. So Nation, anytime you're comparing stocks using this cheat code I'm going to show you, just remember you need to do it at the industry level. I know that's probably more work than you were expecting, but I'm going to be helping you out here with a video on each industry, finding the best stocks across all 71 industries over the next few months. So make sure you tap that subscribe button so you don't miss an episode. Within each industry, you're first looking at the gross and operating margins. Now, these shows the percentage of revenue left over after paying suppliers and production costs. That's the gross margin. And then what's left over after paying operating costs? That's the operating margin. These are your key measures of profitability, and they clue you into the companies that have those advantages in pricing power and efficiency. Within the software industry, we see that gross margins range from a high of 90% to as low as just 70% of sales left after paying those suppliers and the production. In the operating margin here, my favorite measure for analyzing stocks, that operating profitability ranges from as high as almost 60% to some companies still operating at a loss. Beyond these measures of profitability, the final piece to the puzzle is how fast each company grows its revenue. If the margins are showing you how much of that revenue a company can convert into profits, knowing how fast a company is generating that revenue, it's going to be like the trifecta into the companies with the best earnings growth. Here in revenue growth within software, we see that growth as high as 53% and as low as into the single digits. Finding these numbers on your own is fairly easy here. For example, we can go to the financial statements for Microsoft, ticker MSFT, and in the income statement, we find everything we need. For revenue growth, we just take the most recent year's $281 billion divided by the $245 billion the year before to find that 15% revenue growth. The gross margin is the profit left over after paying suppliers and production, the cost of goods just under total revenue. So here we take the gross income, this $193 billion, divided by that $281 billion in total revenue for a 68% margin. And then for the operating margin, we go to the operating income here. What's left over after paying operating costs? That $128 billion divided by the $281 billion in total revenue shows us a 45% operating profitability. Now, the numbers you find might be slightly different depending on where you source them, but should all be within a percent or two. For instance, my data here is from a Bloomberg terminal and within a percent of what we found on Yahoo Finance. I know, folks, not as easy as letting some trained monkey on YouTube just tell you which stocks to buy, but please at least take the time to understand this simple level of analysis. That way, when some Yahoo in a bow tie tells you to buy a stock, you can at least know how to double check that analysis or know if he's just pulling that idea out of his ass. Back to our list, and the Fair Isaac Corporation, ticker FICO, has fallen lately, but is now in good value territory on some great fundamentals. The company is the standard in credit scoring with its FICO model and has a strong competitive advantage in that institutionalization across lending. Even as competition increases from AI, that standard as the credit model across underwriting, risk, and securitization is going to keep subscription revenue strong. Revenue growth and the company's operating margin are in the top 10 among software providers. Fair Isaac converts nearly half, 46% of its sales into operating profits, a sign of its pricing power and great operational efficiency. The company also has improved its profitability over the past 5 years, answering those competitive threats by getting more efficient. But the top pick in the software industry, AppLovin Corporation, ticker APP, up 71% over the last year and still with room to run. The ad tech company's core business is in its Axon platform that helps developers monetize users through ads. The platform consistently delivers better CPA for advertisers and higher CPMs for publishers, making it a win on both sides of its customer base. Scale also matters here in software, and AppLovin is building that customer base that cannot be matched. All this comes through clearly with the numbers, with profitability, revenue growth, and margin improvement all in the top 10 for each measure. AppLovin is not only growing revenue by 21% a year, but converts almost 60% of those sales into operating profits and has improved that operating profitability by 40% over the last 5 years. It all points to some serious competitive advantages and helps explain the stock's 700% performance over the past 5 years. And here I also want to point out some honorable mentions, stocks to watch that didn't make the top 3 but are posting very strong numbers. I've highlighted the top 10 stocks in each measure: gross margin, operating margin, revenue growth, and then the margin improvements. And the first thing you notice here is there are few stocks that stand out as a must-buy on every measure. Then combining those measures with valuation metrics like price to sales is a great way to find those with a competitive advantages, but also trading at a reasonable price. And here, Fortinet, ticker FTNT, stood out as one of my favorite stocks in cybersecurity, posting a top 10 operating profitability. That 31% operating margin is huge in the cybersecurity space, where most of the companies, like another favorite here, Zscaler, are posting operating losses. Fortinet is also much cheaper than these other cybersec stocks at just 9 times on a price to sales basis, so definitely one to pick up. Now, Palantir Technologies, ticker PLTR, also deserves a mention with its giant 53% revenue growth, well above any other stock on the list, and the improvement it's seen in profitability over the last 5 years. It didn't place in the top 10 for that gross or operating margins, but could soon if it keeps up that pace of improvement. And for me, though, I still just can't bring myself to buy in at this valuation, over 115 times on a price to sales basis. Now, if the company keeps up that 53% pace of sales growth, the stock will continue to produce amazing returns. But at that valuation, any weakness in the market or the business, and it's going to drop hard. Folks, this is a great company, and I wouldn't fight anyone if they wanted to invest, but understand there are other stocks with great upside return potential that don't have that same downside risk. I'm going to show you the stocks I'm watching this week next, but if you haven't already, use the special invite link in the description to join me on the Blossom Investing app. I've been using the app for 2 years now and love it for getting ideas and sharing my portfolio. You'll be able to see my entire portfolio, and besides the stocks I'm buying, you'll join over 500,000 investors in the social feed. It's totally free to download and helps support this channel, so look for that link below and check it out. On to the stocks I'm watching this week, and first up, Netflix, ticker NFLX, reports earnings Tuesday with what could be very positive numbers, and a 35% slide in the shares have brought them into value territory. The fourth quarter report is usually a good one for the company, with the stock up an average 12% when earnings were reported over the last 4 years, excluding the harsh drop in 2022. This is as subscriptions generally rise through that holiday season and doesn't even account for the K-pop sensation last quarter. The company is expected to post 16% revenue growth for the quarter and similar growth for the full year to $45 billion, along with very strong 27% growth in its earnings to $2.53 per share. That puts the shares at a price of just 8.3 times this year's expected sales, well below the 10 or 12 times price to sales it has traded at in the past, and 34 times on a price to earnings basis, also a deep discount to what investors have paid in the past. Ally Financial, ticker ALLY, also reports its earnings this week on Wednesday and was down 4% last week on a broader sell-off in the bank stocks. I warned in last week's update that the bank earnings likely weren't enough to justify the financial sector's recent run, and had already disclosed taking profits in Ally in January, with the stock up 27% since we started buying last year. I still think Ally is a solid online bank and a good long-term investment, but it's no longer the cheap stock we bought in at. With the shares typically trading below 1.0 on a price to book valuation, the easy money is made here, with the stock now above that and very little near-term growth to justify the price. And software stocks, including Salesforce, ticker CRM, and ServiceNow, NOW, were down double digits last week on that broader tech sell-off, but also on continuing fears that AI is going to eat into enterprise software demand. Wall Street is worried that vibe coding with AI is going to replace software companies like CRM and slow revenue growth. But I pointed out last week, not only are businesses not rushing to create their own software, but that software companies could see even stronger growth as they integrate AI agents into their business models. Adjusting stock valuations for revenue growth, I'm buying shares of Salesforce and Snowflake, ticker SNOW, on this theme. And shares of Supermicrocomputer, ticker SMCI, popped 11% on Friday and closed 8% higher on the week, despite a reduced price target from Goldman Sachs on Tuesday. I updated my price target on the shares on Wednesday's video, pointing out a 65% revenue growth and potentially a very positive quarterly report coming in February. Now, investors continue to get scared out of this stock, but if you have the patience, folks, this one is going to be above $45 this year and will make you money. Updating our stock market outlook, investors get another glimpse into inflation this week with the personal consumption expenditures, that PCE report on Thursday. Inflation during November is expected to have slowed a little to a 0.2% month-over-month pace from September's report. As with the CPI inflation reading earlier in the month, it's going to be welcomed by investors as further proof the Fed can continue to lower rates. But also, like that earlier CPI report, it's not likely to move the market much because right now, investors are singularly focused on corporate earnings, which started last week. Analysts expect stocks in the S&P 500 to post earnings growth of 8.2% from the year before. Add to that the average 5% that companies generally beat those earnings expectations by, and you've got profit growth of 13% plus. That's the fifth straight quarter of double-digit growth. And it's that strong profit growth that is keeping stocks from being crushed under all the geopolitical stress around Iran, Greenland, and Venezuela. The good news is that with stimulus coming from tax refunds, mortgage bond buying, and deregulation, analysts expect all 4 quarters this year to see that double digit profit growth, as high as 18% in the last quarter. I outlined all the coming stimulus programs in last week's update, and add it all up, and even with stocks as expensive as they've been in a decade, this bull market should keep charging higher. Join me on the Blossom Investing app and see the stocks I'm buying. Join over 500,000 investors in the social feed, free to download with the special invite link in the description. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.